Welcome to the LiveSquawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. Hello and welcome to LiveSquawk's Market Talk. We are today doing a reaction to the US inflation report that was out just about an hour ago. I'll be joined by two guests today, Sam Cutler, who you're familiar with, portfolio manager at 333 Capital, and Jamie Dutta, analyst at PIQ. But before we start, just a quick disclaimer. The content provided on this channel is for the informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of is not indicative of future results. We are not responsible for any losses or gains that may result from the following content on this channel. And with that, let me just get into the number itself. Right. So today we had. Sorry, if you guests could just put themselves on mute while we continue. We had today US CPI reading, and we saw a slight easing in the CPI monthly rate. We saw a 0.2% print on the day. A quick look at the graphics that aren't coming up. So if you can see the graphics, great. If you can't, we'll go through them bit by bit. But quick look at what the numbers said on the whole. Increased by 0.2%, as I said, a tenth below expectations. It fell 0.1% in March, according to the US Bureau of Labor Statistics. Over the last 12 months, the order items index increased 2.3% before seasonal adjustments. That's down from 2.4% that was expected there for that headline annual rate. Just a quick look at the core reading, because I know that it is an important factor amongst all this. Okay, yeah. So a quick look at the core unrounded. It came in at 2.37, 2.4 rounded. Previously, it came in at 0.057 or 0.1 before. A quick look at the unrounded headline then on the month at 0.221% from previous minus 0.05. That core rate then on a year over year came in at 2.8%. That was in line with forecasts. And we saw real average hourly earnings on an annual basis of 1.4, which is unchanged from previous, and the weekly earnings year over year at 1.6 from revised 1.1. A note here I'll try and find a note from some analysts just to give us a bit of context to the number. Actually, let's see what we do. We'll bring in our guests and see what they say. Jamie, what's your first reaction to the numbers?
Yeah, thanks, Harry. Slightly softer services steadily disinflating, basically. Goods deflating is probably stalled. I wouldn't say too much, that much. There's not that many takeaways, I don't think, just because of the uncertainty around the timing and size of obviously tariffs. I mean, that's it for me, basically impacting prices. And everything you read or you think about just says no one really knows what will happen in the next few months with data. So it's tough to read, this one-off data print, really, for me. It's the pass-through effects, which, could be delayed for a number of reasons, because of inventories, because of just people taking time to change with supply chains. And it kind of just all means, there's a lot of uncertainty about these figures.
No, fair enough. I'm just taking a note here from Nationwide. They say, while annual CPI inflation slowed to 2.3% in April, this may be the low point for 2025. As tariff costs interestingly flow into consumer prices, we expect a jump in the CPI this summer, pushing the annual reading back above 3%. This is coming from senior economist Ben Ayres of Nationwide, ahead of just after this morning's April CPI print. He says, correspondingly, economic growth should be soft over the rest of the year as higher prices and economic concerns weigh on spending activity. This puts the Fed in a difficult position of trying to balance faster inflation with a weakening economy, with rate cuts likely delayed until later in the year. Sam, from your perspective, how have you seen today's numbers?
Yeah, thanks for having us on again. So kind of here that I was kind of expecting a softer print versus the consensus. And, we do look at a lot of alternative data sources. And I suggest, that anyone that's interested in trying to forecast CPI or, using alternative data sources as inputs to your model, these things can be a big beneficial, because this is what led me to believe that we're actually going to print on the softer side of things today. So if you look at the Adobe Digital Price Index, right, that came in a lot softer than expected after seasonal adjustments. And this was largely driven by apparel. You also saw softer, airfares, which also gave the indication that we could have some mechanical downside risks. Electronics and furniture came in hot in that component, which was going to offset some of the apparel downside, but clearly not that much, right? And I think this is where consensus was a little different, as everyone was expecting a larger uptick in the apparel due to tariffs. And sure enough, going through this report here, apparel did come in much, much lower. We did see an uptick in furniture. Airfares printed negative for the third straight month. New vehicles eased. Used cars rose slightly, but still overall negative. Core goods were slightly positive. So, this kind of leads me to believe that it's still premature to see any of these tariff impacts, as the main retailers are likely still selling down that inventory that they front ran leading up to these tariffs. We did see core services rise versus the previous month, and this was mainly driven by upticks in shelter. OER was lower versus the previous month.
I'd say it was cooler, wasn't it? Overall, the services costs were slightly cooler.
Yeah, slightly cooler. But it still rose versus the previous month on the service standpoint. Lodging away from home was the main contributor to that. Still slightly negative, but we're still seeing very sticky medical care services here. But all in all, kind of the main drivers for me here was apparel and airfare, which I think a lot of the consensus had not accounted for. Moving forward, I do agree with Jamie there. There's a lot of uncertainty on these tariffs, especially the fact that, we're just essentially, what are we doing? We're kicking the can down the road again, right? So we're, every time we kick the can down the road, we shorten the Fed's runway to cut rates, because they are waiting to see the inflationary impacts of tariffs, right? So every time we kind of push these down the road, we kind of delay when they can begin another rate cut. But I do want to say, I also think it's possible here that we see the tariff pass through to goods come in, but we start offsetting that by a kind of the deflation in the service sector now. So it could keep inflation kind of at bay, right? Which I think would be negative.
For balance things, basically balance stuff.
It'll balance it out, but the Fed is waiting to lower interest rates because obviously inflation expectations from the survey standpoint are rising. Market-based is pretty neutral still. If you look at the one year inflation swaps, right? We're sitting at 234. Even the very volatile 1 year zero coupon swap, I don't like looking at it, but that's pulled back to a very low 3 handle from above 350. So I think that's the kind of standstill we're in right now. And, it sucks to say, but it's really one of those things that it's just going to take time to get a clearer read. So it's a difficult balancing act right now. Oh, and the last thing too, Harry, egg prices. I don't know if you saw that largest monthly decline since 2012.
Yeah, eggs. It's all about the eggs. The President of the United States has mentioned eggs, so we must pay attention to the eggs. Obviously, there's an important point that they are, an ingredient in a lot of food products. So it makes sense to keep an eye on the prices. But a good sign overall, I guess, for the egg markets and chicken farmers overall.
Just a couple of points from me, Harry. Just a couple of points. Just going further what Sam said, I agree with most of it. Shelter is key, right, going forward, because that's the biggest weight, 35% in CPI. We are about 26%. So that's always, definitely worth keeping an eye on. And I think by all accounts, declining rents are falling, and they should show up through this year and into next year. And that's given declines basically on rates in new tenancies, which are actually falling by all accounts. So that's something to keep an eye on. I know somebody has mentioned previously about the appetite for US tourism could be a downside risk as well. I guess the two sort of questions, or the question for me is, how much did tariffs increase? How much was that passed on to consumers? The bottom line, right? And whether non-tariff prices rose above trends, or I guess the other question is, did US importers try and absorb those tariffs in margins? And kind of, whether they can or cannot then will obviously mean potentially less of an impact on inflation going forward.
Well, I think one of the issues we've got, and is again, like you say, the stop-start nature of what we're seeing from these tariff rounds at the moment. Obviously, it's good news at the moment. The US and the Chinese have come to some sort of entente and seem to be happy. There's dialogue, which is always a positive in these sort of situations. But like you say, there's no guarantee we're going to get a deal at the end of it. This is a 90-day thing. We've still got the other 90. We're running through those, the initial 90-day tariff on the 70-odd nations as well, with very few deals actually penned, as far as I can see, really, with some of the key nations as well. So there's use your phrase, a lot of eggs being juggled at the moment, and we don't know really. We're not that, like you say, we're not that much clearer on the path for the trade negotiations, let alone what effects that will ultimately have on inflation and therefore everything else. So I guess this is one of those sort of data points where we are looking at the next data point, and I guess the core PCE, and well, firstly the PPI, which will help inform us on the core PCE reading a couple of weeks down the line, and really in terms of the Fed's gauges and what they're looking at. Any signs that the Fed is likely to do anything or signal anything in the near term? Sam?
I don't think so. Like we spoke about, right? Like a lot of the Fed right now, I believe, is going to be based on essentially what's happening with these tariffs, right? And if you look at, if everything holds that's in place right now, the effective US tariff rate is going to drop to roughly 15%, right? I believe at its peak, it was a little over 35%. The bulk of this cut obviously is weighed on China, right? The tariffs were 145%, dropped down to 30%, right? So if this does hold, of course, it's going to ease some of those inflationary pressures moving forward, and it's also going to be much less of a drag on growth and, of course, market sentiment, right? But like I just said, we essentially just kicked the can down the road. So now we're essentially kind of waiting to see, right? So July 8th is when that 90 days kind of expires for the rest of the world, and now we're looking at August 10th for China, right? Yeah. So like I said, this affects the Fed because I think they have it pretty clear that they're waiting to see the impacts of tariffs on inflation, right? And like multiple people have spoken about, Trump essentially equals uncertainty. So with these pauses, I would bet on an even longer delay from the Fed making a move, right? I kind of expected them to cut as growth kind of weakened. Now I think for the Fed to cut before December, we're going to have to see very negative hard data, right? We're going to have to see non-farm payrolls print multiple times sub 100K or flat sub 50K. And we're kind of seeing that with bets that have been in the market leading up to this, right? Some very active options in SOFRs, right? In those December 25's, the 95.6875 put has been traded a ton. And, that's produced some nice gains and a decent price move. You look at some of these butterflies, like the M5, M6 butterfly, that's moved about 25 bips since the start of the month as we've just kind of pulled cuts out of, that December. I think we had about 4 cuts priced in at the start of the month. Now I think we're looking, I think the market has about 2 cuts priced in. So I still wouldn't be shocked to see that even pull back to where the market maybe prices in, one cut from the Fed. And it's very possible risk here that they're on hold unless we get a meaningful deterioration in hard data.
Okay, so you're going against this, like the current pricing, like you said, which is July, really for the next move at the Fed. Do you think potentially December? And I've seen that call from a number of analysts out there, or a growing number of analysts, I guess, for the Fed. Jamie, you have a similar mind in terms of this pushing back the rate cut, or do you think it's just literally going to be up to a month-to-month view of the likes of the labour market and of inflation reports?
Yeah, data dependency, again, we're going to hear that a lot, obviously, if we haven't already. It's interesting, I think consumer resilience obviously has been sort of catching out a lot of economists in a way, because we've had this sort of difference between hard and soft data, as sort of Sam alluded to. And, the soft data being very poor confidence readings, but that's kind of led many to kind of underestimate consumer demand in a way. And obviously we'll get that on Thursday with retail sales potentially being impacted or not. I think the first move now is September, isn't it? It's been pushed out from June to September for the first cut, pretty much, I think, sort of 75% or so. Now those odds, whereas July, I think, is 60-40, 60 for no cut. That's when I last looked just a few minutes ago. So, they sit on their hands, right? Because they need clarity and they're in the wait and see, mode, stance, whatever you want to say.
But life goes on. Surely, I understand what you're saying, and if you're waiting simply for tariffs on this, then we're waiting. There is the potential that you miss signs elsewhere. I mean, am I wrong with that?
They're data dependent, right? And a lot of that is dependent on tariffs. But obviously, like you've just said, we've had the UK deal and a China deal, but they're deals in virtually not a deal at all. It's just a sort of agreement, and that's the issue, right? So what happens going forward? Do we get more of these so-called deals? But ultimately, you could I kind of think the market's won, right? Besant's won and the market's won, and they've backed down. So they sort of overplayed their hand ultimately. And for the Fed, in a way, Jay Powell, he's probably vindicated, right? His reactive stance, which I kind of thought, here we go, the Fed's going to be behind the curve. Well, they're reactive rather than proactive, and that's been validated again by the U-turn we just had over the weekend, right? So I guess we move on to kind of tax cuts, deregulation potentially, and that's, what we focus on going forward, because now we're just waiting for, amazing deals, which aren't really deals. They're just, agreed negotiations for a plan to talk again in the future.
Yeah, and that's a fair point in that sense. I want to move on now to the rest of the week. Obviously, we've got UK GDP, but we've got US retail sales as well. In terms of where the US consumer is at the moment, I guess their inflation expectations, as you said, are a little bit sticky at the moment. With today's inflation report is on the whole maybe a good thing, because we're not seeing, volatility on prices and so forth. But where do you see the US household right now, Sam, just in terms of their ability to keep this momentum going? I mean, I know we've had some signs of a slowdown, but people think it's going to be limited, and we'll be back to again solid activity down the line. Does any of this put off the US consumer? Obviously, we've seen the ramifications from the US policy on overseas demand, and not just from the markets, but just generally from visitors, lower visitor US visitors and tourism and all that sort of stuff. But how does it affect the US household itself, do you reckon?
Yeah, so I don't think we give enough credit to the average U.S. consumer. I'm guilty of it too. We always say, okay, the U.S. consumer, I don't want to say the words, but maybe not the most. We always put a bad label on the U.S. consumer, right? Sure. And I think we don't give them enough credit, because they seem to handle situations pretty well. And obviously there's all these data things you look at, credit card delinquencies on auto loan payments and stuff. And I don't think those really paint a very clear picture necessarily, right? Because we've seen those rise for a while now without any real meaningful slowdown. Now, I do think the tariff uncertainty did front load a lot of retail sales purchases, right? And I think we're going to see that in this next print, as it should still be a slight rise, but it's going to be much less than the previous month. And the previous months also, all of the three categories were revised about 10 bips higher here. But I think the major driver on this print is going to be kind of an easing in the front-loaded car purchases, right? And then you also have to look at, commodity prices. Gasoline prices fell, so that's going to lead to lower retail sales. But I do ultimately think if we do get, these tariffs implemented, even, if the effective rate does go to 15%, drop to 15%, I should say, I think that is going to see a slowdown in consumer spending. Now, I also think what equity returns do affects consumer spending, right? If equities are continue going up, the average consumer feels good. Their 401ks are going up, the other people's investments are going up. You feel good about yourself. You're willing to, outlay some cash. You're willing to spend, right? But I think I'm going to get into a little mechanical flows here, because I do think a lot of this recent rally is a lot more mechanical driven than an actual re-risking. Right? Because it makes, if you look at it from a logical sense, why are we trading above Liberation Day, right? The effective tariff rate is still much higher. That is going to slow growth down. So why are equities priced this way, right? And I think a lot of this has to do from the systematic side. Vol control funds, right, that kind of level their exposure based on realized volatility, had a huge degrossing when, we had these insane moves, that the VIX was very high, right? They based this on realized volatility. Now, if we're at that 30-day realized vol, those higher vol days are starting to drop out of that look back window. So realized vol is hooking lower, allowing these systematic funds to kind of reallocate a little bit. And I don't think you're seeing as much allocation from the fund community, because you're not really seeing call skew richening at all, right? We've seen, put skew start to flatten out a little bit, vol get a little cheaper here, but we're not seeing a ton of demand for upside here. And we are coming into this, OPEX week. We're in positive gamma, where, volatility is going to be compressed and muted just based on, hedging activities on all these, overripe funds, all these systematic funds. CTAs have started to allocate again. So we're at a very fine point here, to where I believe a lot of this rally was mechanically driven. And I think that creates a very fragile environment here. And once we free this week of OPEX, I think we actually open up a window for equities to pull back down a little bit. Then I'll be curious to hear kind of rhetoric from the admin, because obviously they feel really good about themselves right now. Trump's happy, the market's up, but what's funny? The 10-year's up 50 bips and they haven't talked about it, when that was all they were talking about before, and the equity markets didn't matter. So there's it's, pick your poison on the day, I guess, for what matters to them. But I just wanted to stress that I think, consumer sentiment feeds into, consumer spending. And I believe a big driver of that is equity returns. And this kind of mechanical rally in equity markets, I think, is fragile and at risk. And I wouldn't get too hyped up on, the consumer willing to spend because equities are higher, when I think it's very fragile and we could see a reversal.
Talking of Fit, changed their forecast again, didn't they? They're now raising 2025 S&P 500 target to account for what they say easier tariffs. I think it's a little bit premature. I mean, they were only a week ago saying the world's about to cave in, I think, according to some of the articles I've read. So again, like you say, it just leads to this is probably a pivotal time, like you say, simply because we aren't really any better off than before the Rose Garden event. And so for markets to be now pushing higher, I find it a little bit puzzling.
Well, I'd just add that, and Sam's talked about it, of course. It's the wealth effect, right? But if you don't believe that stocks are the rebound is sort of done and we're going to pull back, then, ultimately that should support spending by kind of the top 20% of earners. And those are the ones who propelled us through recent years, right? So, even as lower incomes have sort of been hit. So, it's whether, stocks can hold up here and whether then that wealth effect does feed through, I guess. But definitely, I'm sorry, just to reiterate Sam's point about front loading, that's the same with all data. So retail sales on Thursday, obviously, front loading of car sales, but then you got onto UK GDP, exactly the same, I think, really, with that front loading again, and then does that sort of mean that data through the year then is impacted and sort of softer going forward?
Yeah, I mean, for the UK GDP, we are looking for a bit of positivity. I think they're looking for industrial production to find some to actually rebound. I think industrial production had a poor start to the year for certain sectors, but I think manufacturing helped out and took the load off of that. I think, if I'm right.
Yes, no, that's right. I think I didn't realise it was the hottest, one of the hottest marches on record, Harry, in the UK.
Yes, I've got the burns to show for it.
So retail sales and construction did helped out big time, I think.
Yeah, retail sales have been outstanding, really, when you consider everything. So it's going to be interesting like that. Just to round up then, today's inflation read then it still leaves us in limbo, so to speak, because that's where we are with the tariffs. And for the US consumer, they remain stalwarts. They remain there to sort of help prop up the economy from that perspective. And really, in terms of the Fed, very little action really. And if you go with the analysts, if you go with what Sam says and Jamie, then we're looking really for rate cuts to be pushed back, if at all. Rate cuts to be pushed back to the latter part of 2025. So December, I think, is, like you say, now the more popular choice for the next rate cut. And so with that, we're coming up to the end of the half hour. So I'd like to thank my two guests, Sam from 333 Capital, Jamie from PIQ. Thank you for your input on this report. Sorry, wasn't it a bit more interesting and a bit more sort of tasty to sort of go through and take apart? But again, it is what it is, and we'll be back for another episode in the near future. For anyone who wants to go back and listen to this from the start, please look on X or on YouTube, and also we'll put this up on Spotify and on other streaming and podcast platforms for people to have a listen to in its entirety. But thank you very much for for listening in, and I hope to see you again soon. Thanks for tuning into the Live Squawk podcast. Your edge in the market starts here. Subscribe now.